Alibaba Group is Brian's first idea.
That's right. This, I guess, would be a household name in China. It's, some would call it the Amazon of China. It's listed on the New York Stock Exchange as an ADR, and it's got a direct listing in Hong Kong. But it is the largest e-commerce operator in China and the largest cloud services provider, in much the same way that Amazon fulfills that role here in North America. What's interesting about this is that although the shares have started to recover, they're still 60% off of their peak reached, in late 2020. But this stock really got crushed and beaten down pretty hard with the COVID lockdowns, and then adding insult to injury, there was punitive regulations around internet companies in China, including measures that derailed or at least delayed the initial public offering of their fintech subsidiary, Ant Financial. But we think that those clouds have parted, and in particular, from just a macro thematic perspective, most of the Western world in 2023 is likely to endure an economic deceleration. China is really off cycle with the rest of the world. It's one of a very, very, very few large economic regions globally that's going to have a meaningful reacceleration of growth in 2023 with the monetary policy taps wide open and with finally these draconian COVID lockdown restrictions easing. So Alibaba has been a secular grower. Internet and e-commerce penetration there is very, very high. 50% of retail sales are online there. That compares to about 7% in Canada and mid-teens in the US. So the Chinese consumer is very much digitally native, and Alibaba has the dominant position in e-commerce. The other thing is there's a catch-up trade in cloud compute spending, where it's only 7% of overall IT spend in China, and it's much higher in the Western world. So that segment is expected to grow at a 30% compound rate over the medium term. And so it's a very timely stock from a technical perspective. It's fundamentally got a very strong entrenched position. The macro thematic forces are behind it. And finally, valuation is compelling. It trades at 9 times enterprise value to EBITDA, which is a big discount to the historical multiple of 14.
Oh, okay. Alibaba, yes, it's such fascinating, the repression by the leader, Xi Jinping, but of course, economically opening up or trying to stimulate the economy. Fairfax Financial is your next idea.
Yeah, so this is a global insurer based out of Toronto, in fact, but with global operations, insurance and reinsurance. They underwrite home and auto insurance policies as well as some specialty lines of insurance. And if you think about an insurance company, Andrew, it's really 2 different businesses rolled into one. The first is core underwriting, selection of risk, pricing of risk, the actuarial work. And the measure of success on that side of the business is what you call a combined ratio, which is your losses from claims and your general and administrative expenses to sell the policies and operate the business. And anything under 100 means you're making money and paying out less than you're taking in, all fully loaded. So their operating ratio has been in the mid-90s, or their combined ratio, I should say, recently, which is some of the strongest underwriting profits they've seen in 10 years.
They're making money on the underwriting.
That's right. And not every insurance company necessarily does that all the time. Some of them will willingly incur losses on underwriting just to get the premiums so that they can invest them and earn a carry or investment income on the float, as it's called. But it's better when you can make money on both sides of the business. So the other side of the business is their investment portfolio. The founder, Prem Watsa, some people have taken to calling him Canada's Warren Buffett. Whether that's true or not, we'll leave that for the history books. But suffice it to say, he's very much a value investor. He's taken big stakes in, turnaround and undervalued equity securities. But the big driver here is their big $35 billion bond portfolio is going to get rolled over at much higher reinvestment yields as those bonds mature. In a higher rate environment, there's lots of losers, few winners. This is a winner, and the stock is cheap at just over book value and 7 times earnings.
And then finally, Fortis, the utility, a regular dividend increaser.
Yeah, so this is very much a defensive play. It's grown up from humble roots as Newfoundland Light and Electric Power. It's now the largest utility in Canada and in North America. It's a conglomerate owning 10 different gas and electric and other types of utilities in the U.S. Midwest, in upstate New York, in different parts of Canada. It's got a 4% dividend yield. It's grown the dividend 49 consecutive years. And its aspiration to grow that dividend at 4 to 6% over the next 5 years is underpinned by a $22 billion approved capital expansion product pipeline. So very timely, very defensive name here.